Hey, good afternoon. Thank you all so much for joining us today for our live FasTech special event, Tech Market Insights with Dennis Reed. Just a few housekeeping items before we get started. The session is scheduled for 1 hour and everyone is muted, so please feel free to type any questions you may have into the chat, and we'll monitor those questions and address them during the Q&A at the end. I'm also recording the seminar, and I'll send out a link to the recording and the slide deck to everyone in a few days. And now I'd like to hand off to Mike Swenson, President of MFC Group.
Hey, thanks, Robin, for the intro. And again, this is the FasTech seminar series. We're doing this as a service for customers, distributors, and principals. And we're hoping you find this of good value as we look at the market and what's going on. This is backed by popular demand. Dennis had a great session with us to kind of kick it off. And we've asked Dennis back, and really appreciative that he's willing to join us today. I think all of us know the market is generally not always predictable. And he gives us a nice pulse on the market in a good perspective on where it's going. So with that, I'm going to turn it over to Dennis Reed of Edgewater Research. And thanks, Dennis.
Thank you very much, Mike, and thank you again to Mel Foster and for inviting me, and for everybody for joining us today. Just to touch base briefly and provide a little intro. To start, I'm going to provide an intro to who we are at Edgewater and what we do. We're going to discuss a little bit, as Mike alluded to, of where we are in the cycle. We'll touch base on some of the disruption that continues to impact our industry. And then we'll look at the industry both from a supply side and then a demand side, and ultimately wrap up with our forecasts for the major segments being semiconductor, passives, and the interconnect markets. As Mike had mentioned, please feel free to ask questions. I've got a ton of info here that I'm going to try to go through relatively quickly so that hopefully we've got 10 to 15 minutes or so at the end for questions. So just to start, who we are at Edgewater. We're an independent research company, and we focus on technology, internet, and then consumer and e-commerce. And really our focus and our thought is, we try to be from, the component level and hard technology all the way through to a finished product at a point of sale and consumer. We do have a team that focuses more on the B2C sales across multiple channels there. And then we do other work in more of the B2B channels that impact our industry. So we work with some of the largest money managers in the world. So if you could think any of your large mutual funds, pensions, hedge funds, it's a reasonable guess that they're a client of ours. But we also work within the industry and in providing critical business insights to our industry customers through what we call fundamental research. We've been doing this a long time. Our reputation dates back well over 2 decades across multiple companies. Our hard technology team alone has north of 55 years of experience, and actually probably approaching 60 plus at this stage. So we've been through a lot of these cycles, and we think it gives us somewhat of an ability to manage both the science of what we do, but also the art and trying to interpret the data or the tea leaves and see where it's going. And why Edgewater and why do our customers work with us? As mentioned, we're deeply connected within the industry. So I not exaggerating, spend my day in, day out, week in, week out, month in, month out, with Zooms, Teams, phone calls, trade shows, you name it, with individuals discussing what's going on. We employ what we call a bottoms up to marry with the top down approach. So bottoms up, we're looking at what the industry is seeing through a sales or a purchasing standpoint, and then we're marrying that with our relationship or top down, which is at the executive suite with many of the largest companies in the industry. As I mentioned before, we're a trusted research for both the investment public, both public and private. And why that matters is it also gives us a lens into where the people that are spending or investing the money to enable future opportunities, what they're looking at, what they're focused at. And then, as I mentioned, within the industry, we are a critical partner, and we do work with some of the largest companies, helping them shape their strategies, both from an overall business standpoint, but then, identifying key growth markets to purchasing in a whole host of other business unit functions for them. How to engage with us, a couple of ways, and I know the team at Mel Foster will provide the slide deck along with the replay, so I won't touch on that, and along with, my background and contract information. All I'll say for myself, I've been doing this for a while, and have spoken at a number of events for the industry, from the ERA national chapter or national meeting to ECIA, as well as events like this with Mel Foster. So to start, I think perspective matters. If your kid came home from college one day and said, "Dad, Mom, I want to work at a business like this," and you pulled up the industry sales and they look like this, I'm sure you'd probably wonder why you spent $250,000 on a college tuition. And likewise, the other side of the equation is, if they came home and said, "Mom, Dad, I want to work in industry XYZ," and you pulled up the industry sales and they look like this, you'd say, "All right, son or daughter, that's a good market to be in. I think there's good job prospects." The harsh reality where we sit, it's the same industry. So this is semiconductor sales with the two segments that I highlighted. And I really just want to share this with everybody to remind you that technology, especially at the component level, is a cyclical business. And within that, as anyone knows, there are good years and there are bad years. But when you look at this trend, from 1999 until where we sat last year, it is a linear up and to the right growth market. But again, any period that we pick inside of there, we can find bad years. And unfortunately, we're in one of those years right now. So how does this compare to other cycles? So, we entered this year on January 1st, and there was a lot of speculation that, it's going to be short, shallow. We're going to burn inventory as a supply chain in 1Q. We're going to stabilize in 2Q, and then we're just going to come ripping back, and we'll be right at peak sales, basically exiting the year on a quarterly run rate. And as this chart shows, peak sales for the semiconductor industry, and this excludes memory and some of the volatility in the pricing actions, peak sales was October of last year. So we are well past the peak. And when we try to compare, what does this mirror, what cycle does this mirror itself to? To date, in this down cycle, we've tracked along the 2011 cycle. And I think there's a couple of things to think about why that's important. When we look at the 2011 cycle, or the cycle that peaked in October of 2011, if you recall back to that time, we had just come out of a black swan event, being the financial crisis. We had Lehman file, et cetera, and the industry slammed on the brakes and then ultimately restarted the engine within a 6-month window, and we proceeded into a massive upcycle. I think the same could be said with what we've seen through COVID, and not trying to make light of any of the humanitarian crisis with it or the loss of humans, but it was a black swan event. Across every single industry, we initially shut down, we opened up, and then the output of that was an unprecedented level of growth. So we know that's what happened. So where do we go forward, and what learnings can we have from the past? And what I would tell you from a semiconductor standpoint, the median peak to trough on a monthly basis was 8 months. And again, this excludes memory. So where does that put us right now? If we peaked in October, we're actually finding the bottom in the June, July period, which is good news right now. The median peak to trough dating back to 1990 is about 14% . So if you look where we've shaked out so far during this down cycle, we're hovering right around down 10%. So indeed, it has been a quote unquote mild or shallow correction, But the challenge is, in the learning coming out of the Black Swan event in 2011, or the recovery from it, I should say, that recovery took a long time to return to peak. And ultimately, that's where we think we're headed with this. The return to peak sales exiting 2011 was 25 months. The median going back to 1990 in a down cycle is 23 months. So when we think about this and we think about where we are going forward, we'll talk about some numbers later. In general, we think the business is starting to show some signs of quote unquote bottoming here near term, in June, and we would expect that to continue into July. That's the good news. The bad news is we are by no means expecting a snapback. We do not have the quote unquote V-shaped recovery built into any of our forecasts. We don't even have an U-shaped recovery built into our forecast. We're looking at this more of an L, and we don't expect any real material recovery in bookings until probably post the Lunar New Year next year. And then we expect real material improvements in shipments, more likely probably starting in 2Q of next year. So again, to leave one message before I move on in this slide, our overall message to our clients in the industry is you're better off to plan your business conservative, right? It's a better operating environment to be chasing sales than put yourself upside down. Put yourself upside down in the cost curve and having to react, because as we'll touch on throughout this presentation, the long-term demand drivers are good. The problem that we're facing right now is purely inventory related. Just to remind everybody and why we're seeing that, and we'll have a couple of slides on that. The compute market's tough, the comms market's tough, the consumer market's tough. The auto market is starting to stabilize and or peak out. So when you look at that, that's putting us somewhere in the 87% of the market is starting to flatten or is declining year over year. Flat out, it's a math equation, and it's very, very hard to grow when 80+% of your end markets are not cooperating. So some good news here, and I've shown this slide in the past, and I would ask everybody a little bit of a rhetorical question. From 2014 to 19, the industry excluding memory grew at a 3% CAGR. When you lump the COVID years in through 2023, it was a 6% CAGR with the 2023 estimate from the World Trade Semiconductor, and you just isolate the quote unquote COVID years and beyond, that rate has climbed to 11%. So rhetorically, to me, I cannot find a market of size that its growth rate has almost quadrupled during COVID. So what that ultimately leads me to believe is we've built inventory across the supply chain. The good news is recently as late last week, the WSTS has revised down their forecast for 2023, which is now, I think, down 12 in aggregate with memory and slightly less. So, they are now pulling the forecast more to, I would say, what is real demand and ultimately real long-term demand, which I ultimately think helps us as an industry move forward, clean the inventory, and then ultimately return to shipping true end demand. So when we think about some of the crises or disruption that we've dealt over the last 3 years, it's really expanded the gamut. We've had geopolitical disruptions, natural disasters, COVID outbreaks, port congestions, material shortages, and just recently, we've had not one, but two, but three or four banks file here in the last 3 or 4 months. And I'm not a banking analyst, and nor would I go on a line to say that I've underwritten every single bank. But to me, at the margin, it's a little surprising that we haven't thought about this or talked about this across the industry. And the reason that it is surprising at a base fundamental level, especially if your regional banks are having financial issues, the overall credit environment will be tougher and tighter, and all that means is the cost of doing business will be higher. As we look at what this has meant from a distribution standpoint, and without naming names on the distributors and how this plays with inventory, distributor one, based here in the US, we've shown their day sales outstanding, or basically their collections, right? Their payable terms over a 22-year window, and they've averaged 82 days. As you can see, exiting the first quarter, yes, there's been some improvement, but they're at 111 days, so substantially above their long-term historical average. Distributor number two is a little bit closer to average, and I would say there's some M&A environment there that I would speculate has ultimately skewed the data a little bit. But again, they're also still trending above, the long-term historical average. So at the end of the day, when we look at an overall tougher credit environment, we look at distribution that has payables extended. We're seeing across the EMS world elevated inventories, delayment in payment terms. I would just leave everybody with the operating environment from a pure financial environment is tighter. And as that flows through, it means the cost of doing business is higher. Again, not trying to make a claim that the sky is falling here, but it's something that we are indeed watching closely, as we think we'll end up in somewhat of a prolonged, at least higher than we've been over the last several year interest rate environment, which is by no means an earth-shattering proclamation here on the call. As we finish out from an inventory standpoint, inventory, as I mentioned, is the problem that we have right now. We track close to over 270 billion inventory globally across the analog, passive, compute suppliers, comp suppliers, distributors, OEMs, ODMs, EMS. And as you can see on the chart, while I know it's busy, the year-over-year numbers are still kind of flattish or showing some improvement. But both on a days and a dollar basis, inventory is at or nearly at record levels. We have seen some inventory. We have seen some improvement on a dollars basis exiting the first quarter, but that was largely driven by the ODM and the EMS channel. Which is, again, if you take that a step further, is also highly skewed by the PC space, an industry that's very, very adept to cutting inventory when needed. And that's also been one of the most demand challenged inventories, industries or subcategories of our industry. Equally, and it's important to note, inventory dollars are a touch inflated because there's been significant inflation at the component level, which is why we also look at it at a days basis. And unfortunately, the days are more problematic than what we see from an inventory dollar standpoint. So what this means to us, again, the supply chain really from sand to silicon all the way through is elevated, and we're in that progress again. As I mentioned, we're in that burn phase, and we expect that to continue largely through the year. How did we get here? Unfortunately, from an industry standpoint, we just can't help ourselves. As I showed on one of the previous charts, the long-term growth for our industry is largely a linear line up and to the right. Unfortunately, the capacity step function, and I think this shows it here. So in 2020, for the industry overall, we had nearly 10% year-over-year growth from a capital spending plan standpoint. 2021, that ballooned to 40+%. 2022, that number was again around 10%. I would leave you guys with, dating back to the 1990s, there's only been one other 3-year window with double-digit capital spending growth, and that was 98, 99, and 2000. And unfortunately, we all know how that ended. I won't go on a line and say that's exactly the outcome, as I mentioned on the cycle slide, but it is problematic, and we clearly overspent. Also, looking at the industry here, I would say, there's some unique dynamics between the foundry market. We know the foundries have spent. We also see it in the compute supply chain. So on the next slide, we attempted to carve out memory, carve out CPU, GPU, carve out foundry, and just look at the analog and passive space. Unfortunately, the story is worse. We saw significant spending, 60% plus year-over-year growth in 2021. We saw 30% spending growth in 2022, and the forecasts right now are still for double-digit growth in 2023. What I will tell everybody is this data is skewed by one of the largest semiconductor companies in the world in Texas, without going into further details. And their operating plan is simply different. They're looking at their targets for 2035. They're not worried about the near-term cyclicality. And one could actually argue that they're making the right investments long-term and not worried about the potential for a near-term cyclical correction. As we shift to demand, I'll start with the PC market. And really, I think the PC market is kind of the best summary of the challenge that we're in from every end market. Prior to COVID, PCs averaged about 275 million units year over year. During the COVID years, it went from 275 to 3 to 330 to 293 in a down year last year. That amounts to nearly 100 million units above trend that we had shipped in a 3-year window. This year, we're expecting somewhere between 250, 260 million. Our actual number is pretty much right at the midpoint of that. But I would tell you, if we're at the low end of that number, we've taken basically 25 million of that upside, and we've burned through some of it from an end product standpoint. Our outlook for PCs going forward is much more of a low, stable growth. Again, 250 to 260. Next year in 2024, we think the market will be somewhere in the 265 range as well. So again, we're making progress, but it's going to be a tougher climb until we recover from here. As we shift to the server market, a couple of things to highlight here. One, our number in our official forecast at down 1% is way too high. Currently, we think the marketplace is tracking closer to down 5 or 6% year over year. And really, it's a tale of a couple of different markets here within the server space. One, from an enterprise on-prem standpoint, the overall demand environment is challenged. The utilization on those servers have been low, no shock there with work from home, et cetera. But then also, as I talked about with some of the credit slides, it is just a tougher overall operating environment. There are real macro concerns right now. So enterprises in general are tight. When we flip over to the cloud and data center side, it's really a mixed bag. And on the next slide, I'll talk about AI. But it's a tale of two markets. The AI market has accelerated and really ramped. From the start of the year, once ChatGPT and et cetera, and the LLM models kind of hit the news. Unfortunately, that is not a story of rising tides raise all ships. As we look at our forecast for various product categories within the artificial intelligence space, what I would tell you here near term, AI is real. AI will be a long growth driver for the industry. It has the ability by the end of this decade to add significant, meaningful dollars to our industry. But in the near term, what we're seeing in 2023, the budgets that were for x86 architecture based servers, those are being shifted predominantly to several suppliers, mainly in the GPU space. So again, we do think it's more of a moving of the total spend with an overall kind of flattish data center spend in a weaker enterprise spend. As we shift over from a demand side to smartphones, the market is still challenged. So last year, the market was down 10.5, 11% year over year. And we're in the market this year somewhere at down, call it 2.5 to 3%. Really, the swing in this is China. China was incredibly weak with the lockdowns last year. There was a hope. That China would improve as the economy opened up. And what we've ultimately seen is the Chinese economy as it's open. The population appears to be mostly focused on services, soft economy goods, similar to what we've seen in the Western world. So again, we think the smartphone market is saturated. We think it's largely challenged this year, and we would look to probably next year before we see any real stability and or improvement in the smartphone market. As we move over to the automotive market, I like this slide, and I think it's a slide that helps frame kind of the differences where we were a year ago. So dealer level inventories bottomed at some point in 1Q 2022 at about 19 days of inventory. This is the data from the first quarter, and we started this year with dealer level inventories, call it 47 days, between 45 and 50 days, but actually it was like 47.3. And so we don't clearly have within automotive the tailwind of refilling the dealers. The other thing that's important to realize is if you look at the categories that I highlighted, the areas that are the leanest, high performance cars, those naturally have very, very low volumes, but it's minivan, compact cars, subcompact, midsize. Those tend to be less content rich opportunities for electronic, whereas the ones that are above midsize SUVs, luxury cars, sports cars, luxury complex, etc., those are all above the natural average. So again, I think it's important just to note as an industry going into this year and where we sit at basically the midpoint of the year, we no longer have the tailwind of inventory and the tailwind of mix from the OEMs that we've had in the last several years. What does that mean for production? Here's our forecast for production. I would tell you, to us, it feels pretty similar to last year. Last year, we entered the year with hopes of 87, 88 million units produced. We ended the year at 78 million. Our forecast for this year is a slight improvement, about 80 million units, so fairly nominal, and we think that forecast pretty accurately reflects the overall market environment. And again, the forecast for next year is in the low 80 range, again, relatively nominal growth. I'll touch on it later. The good news is I think all we really need in automotive is stable production and then the mix shift to EV for it to be a healthy marketplace. But again, we don't have the tailwind or a massive tailwind of inventory. We don't have a mixed tailwind, and we don't have a huge production tailwind this year. As we look at the SAAR in the US, this has actually been an area of goodness in our work. With some caveats. So 2023, the forecast entering the year was about 15.5 million units for this year, off a 14.3 million base last year. So again, about a 10-ish type % growth. Through May, which was the last government data that's available, that has hovered in the 15.3 to, some months we popped, I think in January at 16.5. But all in all, when you average them, we're trending in line with that 15% growth, 10% growth number of 15.5 million units. That's the good news. The challenge has been what's the makeup of that. And when you peel back the onion a little bit, fleet sales have driven a bulk of growth. And for anybody who's rented a car recently, you've probably noticed it relative to the last several years. The fleets are being replaced. That's good for a unit basis, but again, ultimately somewhat hamstrings us a little bit from a content addition standpoint, is the OEMs typically, or I should say the rental car companies typically don't buy premium featured cars for their fleets. But again, it's better to see a 10% unit sell through than it is, dramatic revisions downwards from that. We've tried to frame out, kind of the best case, worst case scenarios in our head. And as we're thinking about the market from a best case scenario, and this would include everything going right, interest rates going to zero, no supply chain disruptions, things that frankly are not going to happen. We'll probably top out somewhere in that, 17.5, 18 million near peak sales. Unfortunately, the reality is that's not going to happen. Likewise, if everything goes wrong, if this financial crisis spreads, interest rates remain stubbornly high, et cetera, et cetera, et cetera, we do think the downside for this year is somewhere in probably the the 12-13 million range. So again, we think right now that 15 to 15.5 million range where we trend is very achievable. So we should see high single to 10% growth this year from an auto sell-through standpoint, which is good news for the automotive channel. As we touch base quickly on the EV market, and again, I mentioned on one of the earlier slides, can you name a market, that has size that's growing substantially? And while EV doesn't have the size and the AI doesn't have the size right now, by 2030, both of those would fit the bill. So we do think EV units go from, touch over 1.5 million in 2020. We think it exits the decade somewhere in the 25-26 million range, and then could be 50+ million by 2040. That is a whole lot of goodness because it is a content opportunity for everybody in the supply chain. As we think about putting some numbers behind that, we would peg that 1.7 million probably equated somewhere in the 7 to 7.5 billion, market size in 2020, 12.5 billion by 2025. And if we're right on that 26 million, it could be an $81 billion marketplace. And if there's a tripling of content, it could be 240 billion plus. What I would leave everybody on the call with, if we're right and it's 81 billion, that's good. If we're right and it's 240 billion plus, that is great. But anywhere in between this, again, we're talking about this market that's 100 billion plus, which, just to frame it from a semiconductor standpoint, that would be about a quarter of the market this year by the end of this decade. And then you throw in the kicker on the previous side of AI, we're looking at potential of close to the market size today in growth opportunities over the next several years. So that is a whole nother goodness as we frame the difference between cyclicality, which is inventory and capital additions, relative to long-term structural growth. From a manufacturing standpoint, I think the chart tells the story here, but I think the way to think about manufacturing is twofold. One, all in the US, we've seen a clear moderation, and some of that is a math equation as we've grown significantly from the COVID shutdown period. The other is, again, it's just a tougher overall operating condition, and we've seen moderation across the manufacturing base. We still see markets like automation. We still see the electrification of the factory. We still see a whole host of markets that offer long-term mid to high single-digit growth opportunities once we get through the industry or the inventory, and once we get some stability in the end demand. It's also important to note how much transportation, as I talked on the last slide about automotive, when you strip transportation out of our manufacturing base here in the US, we've actually flipped negative. And, that is important. We do see significant investments in commercial transportation, from trucking fleets to rail, air, a whole number of industries that are primed to be electrified, for lack of a better term, but also are in need of automation. They're in need of green technologies. They're in need of more efficiency. These are all good long-term opportunities for our industry going forward. As we shift to the defense marketplace, that's been one of the lone bright spots, I would say, this year, has been defense spending. But we tried to frame that for everybody. So on the slide on the top left of the screen, while defense spending has been talked about, and I think a lot of the press and the media have talked about it from the standpoint of the humanitarian crisis with the conflict in Russia and Ukraine, the reality from an overall demand standpoint, we've been on a long-term secular upswing for the last 20 plus years. Now, what's important, I think, to everybody on the call, in the knee-jerk reaction is Russia's invasion of Ukraine has obviously helped spending in the near term. What I would tell people who really want to dig into the defense spending marketplace, look at the Pentagon budget. because where the spend is and where the goodness is for our industry is really not to fight the war within the Ukraine. Naturally, there are certain programs that help. There's content in tanks, there's content in missiles, but really the opportunity for our industry is the war of the future, which, not to be the Grim Reaper, the war of the future, and I think the plans around it largely involve something that would occur over the Pacific. So we're talking about cyber warfare, we're talking about hypersonic missiles, we're not talking about a World War II style invasion, which ultimately will continue this long-term secular trend for our industry as war in general becomes more electrified. To put again some perspective on just where we are here near term, have a 20-year chart of the book to bill. Some of those crazy skews are when you bring massive airplane purchases, big F-35s, things like that into the manufacturing base. But the interesting thing, and probably not surprising, over a 20-year window, we average about 1, which makes sense. We order the stuff. Eventually, we've got to build it and sell it, right? Where we sit today at the end of May is we're at about a 1.1 book to bill for the highest level of the industry. And I would venture to say that's actually one of the only industries with a positive book to bill at the highest level right now. So defense spending still remains strong. But again, I would also just like to caveat, we've been in a long-term secular increase, and we would expect that to continue going forward. So what does that mean? What does that mean going forward? So I wanted to roll out our sales forecast for the semiconductor industry to wrap up, and then I'll touch on interconnect and passives as well. From a semiconductor forecast, we recently cut our forecast to down 12% at the total top line. The big delta in our initial forecast of down 6 or 7% to down 12 came from the memory space. We're forecasting memory down 35% this year as inventory is too high, demand's too low, and pricing is just awful. Excluding memory and the volatility of the memory side, we do think the sales will be down somewhere in that 5% area year over year. So again, going back to that cycle chart, sales peaked in October of last year before declining. We would expect some stability sequentially through year end, and then the year over year numbers start to climb back as we get into the fourth quarter. I think where we're different from some of the other market prognosticators is our outlook for next year. We do think it's a little bit more muted with kind of a 3-ish% growth overall for the industry. The delta, I would say for that, again, we don't subscribe to this will be a V or a U shape. We think there's a lot of inventory, as I touched on earlier, in the supply side, and we just think that will take time to work through. The fundamental demand drivers in our business are healthy. We just have too much stuff of just about everything with the exception of a few golden screws. As we switch to the interconnect environment, our sales forecasts are pretty much in line, I would say, with our overall ex-memory sales, maybe a touch better at 4.5–5%. Really, the delta in our mind is the interconnect suppliers have taken the medicine a little bit more upfront. They don't have non-cancelable programs, or they're not using them as aggressively. The 1Q numbers look a little tougher at the margin than the semi peers. But again, we do think that rebounds. We do see some stability next year as we work through inventory. And then we think the long-term growth driver the long-term trend for interconnects is somewhere in that 5 to 6% through the remainder of the decade, with the two primary drivers being EV and then artificial intelligence. And lastly, to wind up is our forecast for the passive side. And what I would tell you right now is we think this is the most challenged marketplace that we follow. And part of that is how over-indexed it is to Asia, one, and two, the consumer-facing markets, whether it's PC, smartphone, consumer electronics, et cetera. So we do have passive sales down 9 for this year. The kicker in our big concern for this year, down 8 for this year. The kicker and our big concern for this year and potentially into next year is price. We are seeing signs in the margin that OEMs do have significant price fatigue. At the semi space, we've yet to see any real fundamental change. Similarly, could be said with the interconnect space. We've actually seen several suppliers with planned price increases on July 1st in select markets. The passive side does appear that there's more room to work. It's not outright total book price cuts, but we are seeing much more of a hunger, a desire to test the elasticity in the passive space for the right opportunity. So with that, I'll pause. I think we have 20 minutes or so for questions, but what questions do you guys have?
The question we have right now is server versus AI. How different is the hardware?
Yeah, great question. And it's a little bit right now of kind of an arms race, Robin, in the sense of it hasn't fully the actual structure of the build hasn't. It's been such a rapid acceleration, it hasn't been standardized yet. So what you're seeing, where there's big winners and big losers, the GPU is the clear big winner, and it, in some cases it could be 10x plus, right? Just the contents and the GPU cores that you add. So a massive dollar upside in GPU. The CPU space is a big relative loser. There's less memory being used relative to an x86 server. So memory's a near-term loser on the AI upside. The power requirements are significant. So power supplies are growing. But in general, when you interact with any of the hyperscalers, right now they're scrambling, and there are some that have had plans in motion that have an initial lead. There are others who are trying to catch up, and the ones that are trying to catch up, they're looking at a more expensive GPU build, they're looking at a more expensive power build, and they're trying to keep their overall box build flat. And therein lies the challenge, where we go back to it doesn't appear near term. It's a rising tide raises all ship. It'll certainly help the power guys. It will certainly help NVIDIA in particular. And I think that's reflected in their outlook for the third quarter, which is 75% sequential growth. But it's not going to basically dig us out of the whole inventory correction that we're in.
Thank you. Next question is for the auto market. You showed 80 million units for passenger cars. Are fleet sales a subset of that or incremental?
Fleet sales are included in that, so in the production, and then when you take that a step further into the SAR in the U.S., the fleet sales are included as that total light vehicle SAR.
Thank you. What is the memory growth, or what will the memory growth be in 2024?
So we have memory up 15% next year. We are seeing signs, I would say, near term. The memory suppliers, as everyone knows, they've consolidated. There's 5 DRAM suppliers. 3 DRAM suppliers, 5 NAND flash suppliers. They have all been very, very aggressive with reducing wafer starts, cutting CapEx, et cetera, all the things that they should be doing in a really tough marketplace. So the good news of that, in May, in our May memory report, we saw the first time in probably 18 months, forward pricing outlooks have stabilized to slightly up. So that's the goodness right now, that you have seen some stability in the market. We just don't think it's going to necessarily snap back, especially with the tough PC and a tough tough server market.
All right, thank you. Next question: how many announced new U.S. semi foundries will actually get built?
I don't have the exact number off the top of my head, Robin. It would be something I would have to dig through. maybe to expand on it a little different way, TSM spending $40 billion in Arizona alone. I don't know the exact number of fabs that they're going to build there. Intel with their foundry venture is investing heavily in the U.S. and other Western nations, and then I think naturally we're seeing across every customer base a China plus one strategy, or whatever you want to kind of call it, depending on the customer. So we are seeing some level of reshoring at the semiconductor level. Our big thought or concern, and again, this is early, is what does this ultimately do to pricing, right? As I mentioned, interest rates are higher, the cost of doing business is higher, fabs costs are significant investments. How do we pay for it? Does this change the pricing curve that we've all come to expect? Several on the semi supplies would say that it has. And if that's the case, our next question goes to what does that ultimately mean from an overall demand environment where the consumer has largely been programmed that, whether it's an iPhone introduced, they introduce a 15 and that's at the same price with better features and they cut price on the 14 or whatever the case may be. How does the consumer react to higher priced electronic goods? And that's the question right now we don't have the answer for.
Yeah, understand. Next question. Can you discuss onshoring trends, US versus Mexico?
Sure. So I think at a high level, it first and foremost, it depends on your product category that you talk about, right? So if you're looking at semiconductor manufacturing, Mexico does not appear to be in the realm of fab build-outs in any large scale, where that's more US, Germany, other more industrialized countries, if you will. When you look at more of your traditional EMS, you're clearly seeing a push to bring that, at least for North America, back to Mexico. There's a couple of challenges, and I alluded to it with the last question, and it's ultimately that elasticity for end demand. So, let's put a perspective for your biggest iPhone or the biggest cell phone supplier being Apple. Their stated target is 25% of their iPhone production out of China into India by 2025, so 2 years from now. They're also telling their suppliers, we want you to support that, and suppliers are going through and looking at anywhere between 10 to 30% more logistical costs if you're manufacturing a connector, let's say in Japan or Korea, just with shipping routes, how do you get it there, air freight versus ocean, et cetera. And Apple, in the same time, is demanding pricing at 2019 levels or lower, right? So there's a fundamental challenge, I think, overall with the pricing, kind of that pricing and how it comes to reshoring. So, we're seeing clearly the China plus one strategy, but I don't think China goes away. I mean, the big, the harsh reality is last year, the single biggest lessor of industrial and manufacturing leases in Mexico was actually Chinese companies. They accounted for 18 or 19% of all industrial leases last year in Mexico. So in one case, we could see production moving back to Mexico, but I don't think we'll quite get away from the arm of China's overall manufacturing base. And if we do, it's going to come with a significant investment. I think the big thing that we've noodled around, and I don't have hard data for this, is just looking at reshoring from a long-term trend. So China entered the WTO, I think, in 97 or 99. I can't remember exactly what year. But we're approaching roughly 25 years where they've been able to train workers, build university systems, build the factory networks, build the logistic networks, et cetera. I don't think there's a light switch that we could switch on globally that changes that. So I think you're better off to measure reshoring in probably decades rather than years.
That's interesting. Thank you. And I think you've talked about this already, but do you have any other thoughts on what will happen to the memory prices in this year, 2023?
Yeah, so our overall DRAM, so I think it's a little bit of a dichotomy between DRAM and in NAND flash in particular. So for DRAM, we see it flat to up through the remainder of the year, but again, we're not expecting 20-30% increases because inventory is still very, very elevated. And at the end of the day, there's probably 15 customers between your PC OEMs and your cloud providers that consume most of the memory, and they're still elevated. So we see flat to up for DRAM. NAND flash, I think, is a little bit of a different story. I mean, there's the disruption between WD and Kioxia Kioxia, sorry, in the merger discussions that could have a stabilizing. So I think in flash, we think the fundamentals are more challenged than DRAM, but we would put that as probably stable best case for the rest of the year.
Okay, and one more question. Are there any specific indicators to monitor that correlate to forecasting price activity in either direction as related to foundry increasing or lowering prices to suppliers? I see suppliers indicate no outlook for lowering prices.
Yeah, great question. And unfortunately, I would say there's no publicly facing data yet, at least at the foundry level. And that's a lot of what we do with kind of our qualitative work. And as I mentioned, I live in the supply chain from kind of sand to silicon to distribution, EMS, purchasing, OEM purchasing, et cetera. So we tend to pick up on that one. Two, which, I'm getting a little bit ahead of myself, probably, but Edgewater has we've just signed a partnership with one of the leading software companies within our industry. And one of the things that we hope to roll out by the end of the year is real-time pricing indices at a high level, then by product families, whether it's microcontrollers, MOSFETs, Interconnect, kind of you name it, and then within that, even for within individual suppliers, and the suppliers to think of are the ones that probably encompass the top 30 largest in the world. So there's more to come, I would say, from Edgewater, and for those interested, the scanny thing, which I don't know what they call those QBR codes or whatever,
QR codes.
has my contact plus my cell phone, email address, everything else is in the slide deck, and would be happy to discuss kind of when we hope to have those out in the second half.
Very interesting. We look forward to that. Those were all that. Actually, there's one more question that just came in. Where do you see the semi market in 2030?
2030. So, earlier last year, I think, we had the numbers, approaching, $1 trillion or a touch below it in annual sales. I mean, that number's come down a bit, and I don't remember exactly where our 2030 number is, but to shape the framework out, we think this year, again, down 12, including memory, next year up 3. And then we do see kind of a return to trend of, we think the long-term trend is mid to high single digits, so 6 to 8%. And you flow that through with kind of the correction this year, you're probably in an $800+ billion market in 2030.
Thank you. There's another question. Are your growth numbers tied to more to increase prices or increase unit sales? Just curious how you weigh these factors in your forecasting and how we should view these numbers.
Yeah, so that's a great that's a great question. I'm sure for everybody on the call, outside of the memory space, it's nothing is quite as clear as memory, where it's bits times ASP equals sales. As you get into interconnect, or you get into passives, or you get into the broader semis, you've got mix and end market and everything else. So our outlook, when we look at kind of that 6 to 8%, we do think we ultimately go back to what is traditional, kind of price declines from the non memory space, which, has historically been 1 to 3%. And the onus is on the suppliers either to introduce new products, or if it's 3% find efficiencies in your operations. So we think we think the pricing environment returns to normal, and I would be clear to say that's not a new normal. It's the normal that we had all lived in prior to COVID.
Okay, very good. And that was the last question. Dennis, we'd like to thank you for taking the time. This was great insight, and we always enjoy having you present. Thank you. Mike, did you have something?
Yeah, I just said a couple words too. Incredible job, Dennis. We appreciate you doing this session. And then our goal is, Dennis, please nod your head yes. Towards the end of the year, is to have Dennis back on, so we get as we go into 2024. I think people would like more clarity as we get closer to 2024. So we'll have this again towards the end of this year. And again, thanks for attending today. If you have any feedback on anything we could have done differently, better, anything about the session, let me know. I'm seeing a lot of hand claps, which is a really good sign, Dennis. So, but thanks again.
Thank you, guys. Thank you again, Mike, and the team at MFC for the invite. It's always an honor to speak to the industry.
Okay. Thanks.
Thank you all. Take care.
Thank you.